Well, good evening. So let us start the session. Today we are taking up contractors or risk insurance, vis-a-vis contractors erection, or you can say erection or risk insurance. Means CAR and ER both. We are taking a comparative study. This will make our understanding better. So let us see what is CR and ER insurance are. So first of all, you must be aware that both the policies are part of the engineering section. And engineering insurance means the class which refers to or which provides the economic safeguard to the risk faced by ongoing construction project, installation project, machines and equipment and project operation. These are the three things which are focused in the engineering section because the economic safeguard to the risk provided under the engineering section relates to these three things. That means engineering is one class of insurance that provides the financial safeguard to all those products which are where the construction is going on, installation is going on, and for the safety of machineries and equipments. But this engineering section is very creative because the creation is there, designing is there, construction is there, buildings are there. All these forms the part of engineering insurance. So when the engineering classes combines, the risk become the larger because wherever there is a creation activities, the risk will automatically increase. Now the question is, why a CR policy is required? Or a contractor service policy is required, and who will take it? Why it is so important? See, this you can understand because the India or say our country is among the fastest growing economies in the world, with an upbeat outlook towards rapid infrastructural development. So when we say there is infrastructural development, it doesn't mean it is on the paper. It doesn't mean it is theoretical. There must be some development process of infrastructure should be there. And the infrastructure for an economy depends upon the railways, industrial units, housing facilities, dams, flyovers, power plants, and other such construction projects. Because these are the projects which make an economy grow. But at the same time, when these infrastructural developments are taking place, there is a rise in the risk also. Because when the infrastructure projects will rise, at the same time the risk will increase. And that risk will be material risk. Because the possibility of damage to the construction material or to the machinery or to the constructed portion due to environmental and man-made hazards can lead to substantial losses for the contractors. This is important to understand because contractors are the people who are contributing in the infrastructural development. To be more clear, I give you some example. If some road is to be developed, say NHA is constructing some road of say 50 kilometers or 100 kilometers. So NHA is not active in that construction work or development work. Some tenders are given and the contractors are working on that. Some stadium, some flyover, some dam are under construction. Who is doing that? Contractors. Tenders are invited, contracts are given. This contractor may be an individual person or an entity or an office or a registered or corporate office. Because there are big firms who are engaged in such projects. Big firms are required because huge capital investment is required. So when you are constructing or developing flyovers or dams or even railways, huge investment is required. Long-term planning is required. So for that purpose, because the project is big one, the risk will be the huge one. Amount involved is huge one. So for these purposes, contractors always policy is required. Now there are many types of engineering policies. They can be classified into annual and long-term project insurance. If we talk about the annual policies, you will find contractors, plant and machinery, that is known as CPM insurance, electronic equipment insurance, that is known as EEI insurance, MBD policy, that is called as machinery breakdown insurance, BPP policy, that is boiler and pressure plant insurance. They are all annual policies. Here annual policy means the policy is renewable at the expiry. Means even on the expiry date, if it is renewed, policy will run in continuation. Secondly, the policy can be renewed on the same terms and conditions and or changed terms and conditions. Thirdly, policy is renewed for 1 year normally because they are annual policies. But even if the proposer wants, they can take it for short term, but not more than the 1 year. So this is the special feature of these annual policies. But just opposite to it, just vice versa, is the situation in the long-term policies. They are also known as the project insurance. What is there? These policies are, first of all, contractors always policies and erection always policies. Only these two policies are of long-term policies under the engineering section. Now, what is special with them? These policies cannot be renewed. If the project is not completed within the policy period, within the stipulated time, the policy can be extended. If the project belongs to 1.5 years, 2 years, 3 years, policy can be extended for further period, but on the same terms and conditions. So normally in these policies, terms and conditions are not changed. Period policy is not renewed, it is extended. That is the difference. So these policies are according to the time factor. Annual policies and long-term policies. Another classification relates to the phases. Means at what phase what policy will be given. If the construction phase is there, some project is under construction, so construction phase is there. Here, the period policy or the one-time policy will be given. That is contractors always, correction always, marine income erection, advance loss of profit, and delay in startup. Delay in startup and advance loss of profit are the same thing. But in these two policies, advance loss of profit or marine income erection, the terms and conditions are different. and they are not necessarily for a longer time. And there are other policies which relate to the operation phase. Means in operation phase, any policy is taken for the maintenance and repairs. A variety of machineries are used in the factories or in industrial units. So for their repair and maintenance, the owners are taking the policies. For example, for machineries, machinery breakdown; for boilers, boiler pressure and plants. They are for maintenance, repairs. But with the machinery breakdown policy, MLOP policy can be given. That relates to the loss of profit. For contractors, plant and machinery, CPM policy is there. Civil engineering completed this policy is there. Electronic equipment policy is there. Deterioration of stock insurance is there. They are all for repair and maintenance because these relates to the operational phase. These policies are different in nature because their maintenance period or operation period could be different. But the subject matter insured could be of different nature. Say for example, the policy is required for the residential or official buildings, hospitals, schools, theatres, production facilities, infrastructure facilities, bridges, dams, tunnels. All these kind of projects needs insurance protection. Maybe at whatever stage they are, but the insurance protection is required. So the policy, CR policy, has two important sections. One is material damage and the other one is third party liability. Third party liability is also a wider section because bodily injury and property damage both are covered. But the material damage section is widest because it covers every kind of risk. Or you can say this is an all-risk policy, everything is covered other than the specific exclusions. Everything is covered because these are known as all-risk policies. But the period of cover is important. When the risk will start and when it will expire, both have to be understood specifically. Because when you are understanding a product like engineering insurance or CR policy or ER policy, if you are not aware when the risk has started and when the policy will commence, it is difficult to settle the claim if there is any loss. So here in this policy, the cover shall commence from the commencement of the work either or arrival of first consignment at the project site, whichever is earlier. Means in either of these two circumstances, the policy will start. Either the project is started or the first consignment has arrived at the project site. The consignment could be of construction material, plant and machineries, equipments. If it has arrived at the project site, it means the safety is required, protection is required. Otherwise, on the day one also there could be losses. So on the same day the policy will come into force, whichever is earlier. Now the question is when the policy will expire. So for expiry there are three different circumstances. One, when the completed part thereof is taken over. Means the project is completed and handed over to the principals or owners. Second, put into the service. If it is any service unit or industrial units or production unit or manufacturing units, it is put into the service means the policy expires. Third, date is specified in the policy, that is the expiry date of the policy. Whichever is earlier. If the policy date is expiring and the project is not completed, it can be extended. If the policy date has expired, project is not put into the service, still the coverage is required. So in case the work is not completed within the period specified in the policy, then the policy can be extended. It is not renewed. Extended means maybe for 3 months, 6 months, 9 months, 12 months, 18 months, 24 months, whatever period is required for completion of the project, the policy can be extended. So what is the basic difference between the CR and ER? Try to understand, because this is a normal question, but the answer should be very specific. Both are engineering policies, both are always policies, both relates to the projects, both are long-term policies, but the only determining factor of the difference is value of erection and installation work. What is that? If the 50% or more than 50% cost, if more than 50% cost relates to the erection and installation work, in that case, erection or this policy will be given. If more than 50% of the total project cost relates to the construction or civil work, in that case, CR policy will be given. So the civil work or construction work requires CR policy. But erections and installations and machineries requires ER policy. Not in every case. Only when the value of erection and installation work is more than 50% of the total cost of the project. So in simple terms, this is the determining factor which will differentiate the CR and ER policy. Now what are the unique features of CR policy? In majority of proposals, there will be risk inspection by the company's engineers. You know, all general insurance companies are hiring risk inspection engineers and they are employees of the companies. Their services are utilized for inspection of the risk, even for those risks which has not yet started. But if the proposal is there, the proposed plan has to be seen, that has to be inspected, the site has to be inspected, and what amount or volume of money that is going to be constructed, that has to be seen. So the inspection report of risk engineer is very important in the engineering section. For underwriters, this is the most important document on the basis of which they are deciding to take the proposal, whether to accept it or to reject it. The role of risk inspection engineer is very important for engineering products. Duty of utmost good faith applies. So it is the duty of the proposer to disclose every material information. Material information means which can impact the decision of the underwriter, whether to accept the risk or reject the risk, or if to accept, at what rate it has to be accepted, because there are methods of applying the warranties, conditions, compulsory excesses, and these are the prerogatives of the underwriter, so they can apply according to the recommendations of the risk inspection engineers. Warranties can be put, conditions can be imposed. Policy can be issued in a joint name of two or more parties. For example, principals, contractors, and subcontractors. They are the only related persons. Two or more party doesn't mean anybody or everybody. Only they are the persons, principals, contractors, and subcontractors. That's all. Almost all classes of engineering insurance are controlled by tariffs. As far as your common sense is concerned, you will easily say, as on that there are no tariffs are dismantled. Of course, I do agree. But for the sake of pricing, though the IRDA has dismantled, denotified tariffs are no longer in use. But the insurance companies are following the same terms, conditions, wordings, and clauses which are provided in the tariffs. On the basis only they have developed their products. Because that has simplified the procedure and documentation as well. Because the format of proposal form, policy form, claim form, everything is there in the tariff. So that is the workbook of the insurers. Then the sum insured is adjustable at completion of the construction on the basis of actual value. So these are the unique features of the contractor's all risk insurance. Now, am I audible or not? You can hear me now? Okay. So now, for CAR, this policy can be given for those risks only which are located in India. To be more clear, I give you an example. I am a contractor. I am constructing two bridges. One in Panipat, one in Kathmandu. As a contractor, I can take the policy, CR policy for my Panipat bridge, but cannot take the policy for my Kathmandu bridge. Simple reason, because that risk is located outside India. I may have any number of projects. I can take any number of policies for my all those projects, because the individual project needs individual policy. But risk must be located in India. And value of the civil works involved is more than 50%. Civil work means construction work. If the erection work is more, if the installation work is more, if the machinery work is more, in that case, ER policy is required, erection not this. So principal, contractor or subcontractor, anybody can take and jointly can also take. So for you, your target segments are government contractors involved in government projects like road construction, bridge construction, building construction, and additionally, builders and developers of townships. They are also your buyers. Because they are also involved in huge projects. They are developing the not only colonies but complete towns. You know, the Gurgaon is built by the DLF. Number of DLF towers are there. So builders and developers of township are your good customers. This kind of projects, you can see, they all need CR policies. Because the civil work is more, construction work is more. Now the policy has two sections on the material damage and third party liability. But this material damage has the variety of risks covered. How can say variety? Say for example, fire related perils. Fire, lightning, explosion, theft, burglary, windstorm, flood, inundation, earthquake, landslide, rock slide, subsidence, all these perils are covered. Why they are covered? Because they are not specifically excluded. Policy is always policy. In addition, construction faults, defective material, workmanship, collapse, subject to exclusions. If they are not excluded, they are covered. Human error, lack of skills, negligence of workers, they are all covered. Other perils beyond imagination. You will never think even. Air crash, blasting, because they are not part of the project, but still they are covered. Policy is always policy. It is covering everything which is not excluded. This is a real image of the loss. Now you can imagine the losses. Every kind of loss is possible in this kind of loss. Machineries, persons, animals, buildings, everything is possible. Huge loss it is. You cannot even guess what would be the amount of loss. Now the question is how to decide the sum insured, because policy is subject to underinsurance, subject to average clause. That means underinsurance should not be there. Sum insured should be full. When you are taking the full sum insured, that means you are including machineries which are imported, machineries which are purchased from India, cost of construction, cost of permanent civil engineering work, escalation cost, and in addition, all cost of materials, wages, freights, custom duties, construction cost, and material or items supplied by the principal. Still, it is not sufficient. Because during the construction period, the cost may increase in multiples. If you have noticed any project, say a bridge is under construction, and the bridge will take 2.5 years. Projected cost of the bridge is only 200 crores. But by the time the bridge was completed in 2.5 years, the total cost reached 450 crores. Cost can reach in multiples. Why? Cost will increase always upward, because cost of material increases, cost of labor increases. All these factors contribute to the increase of cost. That means sum insured should be adequate, maybe more than the projected cost. Still, the escalation clause should also be taken. That will cover the escalated cost. And in addition, it is upon the proposer to go for add-on covers also. Policy provides third-party liability add-on, surrounding property of insured add-on, escalation, removal of debris, CPM, maintenance. They are all add-on covers. Don't get confused that CPM is an independent policy. It cannot be an add-on. Of course, it is an independent policy of CPM, of engineering class. But here in contractors or this insurance policy, to a limited sum insured, this can be given as an add-on cover. So these add-ons are available, but they are all voluntary. At the same time, they are all available only on the payment of additional premium. This is again a real loss image. So in such losses, the amount involved is huge. But CAR policy provides coverage for everything, except those which are excluded. What are the exclusions? Because these exclusions are important. Other than the excluded reasons, everything is covered. These could be willful act or willful negligence, loss discovered at the time of event, loss or damage due to faulty design, consequential losses like penalty for delay, non-fulfillment of terms, cost necessary for rectification or correction, and bodily injury or illness of employees of workmen of the contractors. This is separate. Separate in the sense, bodily injury or illness of employees or workmen of the contractor. This risk is separately excluded because this is part of the other policy, and that policy is known as the workman compensation insurance or employee compensation insurance. So this is not included in the contractor's service policy. So these are the specific exclusions of the CR policy. But at the same time, third-party liability coverage can be given in the wider sense where the risk can be opted by the proposer as any one person or any one accident, and accordingly the extra premium will be charged. So third party liability cover is always required for the higher limits. This is again a real loss image. Nothing to explain because they are two passerbys were killed. That means they were third parties. And for third parties, whatever limit has been selected, that will be paid. So now the loss could be of any nature, maybe the partial loss or the total loss. If the partial loss is there under the policy, this policy will pay necessary repair charges to restore that property to the original condition, minus under insurance, minus salvage, minus compulsory excess. Under insurance will be deducted only in case where the sum insured is not adequate. Similarly, the procedure with the total loss. But the claims are settled immediately because the huge losses are involved. And at the same time, the contractors are also getting that policy restated by the amount of claim which is deducted from the sum insured. Now, when this policy is given, the premium rate is applied according to the nature of the project. Because project could be of different nature. It's a hospital building, it's a bridge, it's a road, it's a tunnel, it's a stadium. So whatever is the project, rate will apply according to the structure. Because certain structures are in open, certain are in covered. Moreover, the location matters. So for every project, the structure is separately decided in tariff. Then mid-term cover. Mid-term cover cannot be given. In case any project has already started, mid-term cover will not be given. But if at all any insurance company is giving mid-term cover, they will put two conditions before the proposal. What two conditions? If in case the project has already started, policy can be given mid-term, but the premium shall be charged from the commencement of the project. Second, insurer to submit a declaration from the date of commencement till the taking of policy that there is no losses. If the insurer is ready for these two things, then only the mid-term cover can be given. A small term policy can be given. If the project is for 6 months only, contractor will take the policy for 6 months only. That can be given. Extension is given only when the project is not completed within the policy period. So policy can be extended. If the change of insurer is there, this is a very critical factor. Policy is taken from one insurer, extension is sought from the another insurer. Why the another insurer will give the extension? And if he is giving, then he will put a condition that the premium shall be charged from the date of the commencement of the project. Without taking the entire project premium, no company will give the extension. Installment facility is there. In case the project period is more than or equal to 12 months, premium can be taken in quarterly installments. Higher discount can also be given because this is a tariff provision. But for that, the insured has to bear multiple times compulsory excess. If 5 times he is ready to bear 10% discount, 10 times he is ready to bear 20% discount, 20 times he is ready to bear 30% discount. But the provision is there. Now, two important clauses are there. 50-50 clause. This is required by the contractors because they are aware of it. So they may ask to you to arrange 50-50 clause with the policy. This 50-50 clause is applicable when the policy is terminated or expired or it is not in force, thereafter the loss came to the notice. When the contractor files the claim on the insurance company, obviously the insurance company will reject the claim because the policy is not in force. But the contractor says the loss took place at the time when the policy was in force. Insurance company has sent the surveyors, investigators to assess the loss. But the reason was not ascertained whether it is the current loss or the loss occurred during the policy period. So in such a disputed condition, both insured and insurance company will bear 50-50 loss. 50% will be borne by the insurance company and 50% by the insured. Another important clause is 72-hour clause. This is also required by the insureds. This is because these engineering policies are subject to very high compulsory excess. Very high compulsory excess in terms of percentage of the loss. So there, if the loss has reported on different dates, different claims will be registered in the office of the insurance company. Maybe the location is same, project is same, cause of loss is same, but the loss has taken place on different dates. Very typical, but it is possible. Try to understand again. Location is same, project is same, owner is same, even cause of loss is same. But loss has caused on different dates. When it is reported to the insurance company, different claims are registered because they are reported on different dates. And for each claim, there is a compulsory excess. So multiple compulsory excess will be deducted. Say for example, the losses caused by earthquake or flood or cyclone. So first day, one portion of the building has fallen. Second day, another portion has fallen. Third day, another floor has fallen. On all 3 days, the insured has reported 3 different claims. If all 3 claims are processed for the same location, for the same project, why the same reason, but insured has to bear different compulsory excesses on each claim. To avoid such a controversial situation, this 72-hour clause is taken. This will save the insured from different compulsory excesses of the different claims registered by the insurance company, but for the same project. So for the purpose to save the money of the insured from the compulsory excesses, if this clause is taken, the losses caused within 72 hours will be treated as one loss, and only one compulsory excess will be deducted out of that. So that will save the cost of the insured. Now the difference of CR and ER is clear in your mind. If the more than 50% cost of the project belongs to civil construction or buildings, CR policy is given. If more than 50% of the total cost of the project belongs to erections, installations, equipments, then ER policy. This is the simple difference, and this is the technicality of the CR policy. Now if you have got any questions, I'm open to answer. Any questions from your side?